Most financial advice is built on a false choice, that you must choose between safety or growth and between access and returns. But it's really not a real choice. It's a structural problem because your financial plan is likely to be leaking wealth in ways you don't see. Not because of bad investments, just because of a flawed design. I want to show you today the 3 most common leaks and how to fix them for good. I call these the liquidity trap, the velocity drain, and the fee hemorrhage. The first leak, the liquidity trap, means your capital is locked. In accounts like a 401k or an IRA, you're penalized for accessing your own money when you need it for an opportunity. It forces you to sacrifice control for tax efficiency. The second leak, the velocity drain, this means that your money is sitting idle. It might move once a year, but the wealthiest families know that wealth is built when my capital, my money, begins to move through my control multiple times a year. Most plans have zero or almost zero velocity. And the third leak is the fee hemorrhage. It's a slow bleed from hidden cost because what you may not understand is a 1% or a 2% annual fee doesn't sound like much, but over 30 years, it can consume nearly half of your potential returns. It's wealth that simply vanishes from your account. These leaks exist because the financial system is designed to benefit institutions and banks, but not individuals. But there's a way to reclaim control. The solution is to build your own private personal banking system. It's a structure built on 5 core principles. We're going to call them the personal, private, or privatized banking system. The first pillar is structural ownership. This means you own the account. You own the account outright. It's not an account held by someone else because you can make the capital deployment decisions. This has to align with your structure, with your goals, not an advisor's commission targets. And the second is uninterrupted compounding or uninterrupted compound interest. When you borrow against your policy, the underlying capital continues to grow. It continues to compound as if you never touched it. You get to use your money without stopping the growth. This is fundamentally different from any other kind of loan. The third pillar, liquidity without penalty. You can access your capital on demand with policy loans with no surrender charges, have no tax consequences, but when an opportunity arises, your capital is ready. The fourth is the velocity of capital. This system is designed for movement. By borrowing and repaying yourself, your money continues to move through your control, multiple times a year or as often as you need it. Each cycle compounds your wealth through strategic deployment, not just passive returns. And the fifth pillar is generational transfer. You see, this policy or this account becomes a mechanism to transfer wealth and financial knowledge. You're not just leaving money, you're leaving a functioning family banking system, just like the Rockefellers did. These 5 pillars work together to create a resilient financial structure that you control. Now let's look at a quick practical example. Imagine being a business owner who needs $50,000 for a time-sensitive inventory purchase. With a traditional plan, you'd have to go to the bank and pay 7% interest, and that interest is gone forever. Or you might have to sell investments and trigger taxes and interrupting the growth. With your own personal banking system, you can borrow $50,000 from your policy. Your policy's cash value, let's just say it's $150,000. It continues to compound as though you never touched it. And you can repay the loan on your schedule. The interest goes back into your own banking system, and it further increases the account or the policy's value. You're able to capture the opportunity without losing control or interrupting the wealth and the growth. The outcome is fundamentally different. In one scenario, wealth is transferred to the bank. In the other, it's recaptured and compounded within your own banking system. This is the power of structural design. At this point, the most common question is, isn't this just a whole life insurance policy? I've heard that's a bad investment. Number one, it's not an investment. And it's a fair and important question, but the answer is yes, it's a whole life insurance policy, but it's designed in its structure in a completely different way. Most policies could be designed to maximize the advisor's commission, resulting in high fees and slow growth. A personal banking policy is designed to maximize your cash value or equity and your liquidity from the very beginning. It's the same product, but a different design, a different architectural design, which creates profoundly different outcomes. If this principle-based approach resonates with you, I'd like to invite you to have a conversation. This isn't a sales call, but it's a diagnostic session where we together can map out your current financial structure, and we can see if there are any leaks. We'll determine together if this kind of structure fits you and your specific goals.